like it's an unambiguous positive for the US dollar. Two main channels. First of all, tariffs. We've seen them used before. We know the US dollar responded positively to those. And you can see why, because the tariffs are, in a way, designed to weaken the economy of the US trading partners. And of course, a weaker economy often breeds a weaker currency too. And the consequence of that, I guess, is if you do it on a broad scale, then you're going to see broad-based US dollar strength. Now, there may well be some retaliatory responses from trading partners, and that will also slow US growth potentially. But the beauty about the US dollar is it can actually thrive in a slow growth environment too. So we get the US dollar safe haven characteristics kicking in, boosting the US dollar in any sort of a tariff-like environment.
Let's talk about the Fed's easing path. And, you know, this doesn't look like it's going to be that linear. We've had a number of guests come in who said that they've sort of revised down what they're penciling in for next year. I mean, what sort of implications does that have, not just for other central banks, but also on some of these regional currencies too, if we don't get as many cuts as perhaps some were baking in previously?
Yeah, I think it's a fair assumption to assume that the Fed will not need to cut as much as they otherwise would have because of these developments. And tariffs, of course, would be one reason for that, because they should stoke US inflation, and higher inflation means less need to cut. So we're currently revising our Fed forecasts. We had been looking for 4 cuts in each of the first 4 meetings for next year, but it now feels as though perhaps the outlook has become a little bit more murky in light of what's happened in the US. Now, of course, all of that refers back to your question on the US dollar, because higher US yields should lead to US dollar strength as well. So again, another dollar positive element to the story.
Gareth, I want to ask you about the Fed, and as we, of course, watch and track the changes that will come with the Trump 2.0, we're also tracking, of course, his new BFF being Elon Musk. Both of them now endorsing presidents to have more say over the Federal Reserve, to let presidents meddle with the decision of the Fed. Can you weigh on this in terms of the Fed's need for independence and whether or not a U.S. president can intervene on Fed policy?
Yeah, so one of the pushbacks we've received over the last few months on our broad US dollar strength view is, what about the Fed? What about the risk that Fed independence might be undermined by a future US administration? And, it's a credible argument. It's something we can't dismiss immediately, but we heard the same argument 8 years ago, and during President Trump's first term, he had the opportunity to select 2 new faces for the Fed board. And who did he choose? Very credible economists that deserved the role. They were experienced, and certainly they've distinguished themselves in how they've conducted policy during their term so far. So the theory that a future administration might parachute in to these vacant seats policymakers that might be sympathetic to a particular cause, I think that danger didn't play out the first time around, and I doubt if it will the second time either.